Every year, millions of people try to figure out how to make their money work. They research for weeks, they watch videos, they read threads, and somehow, the more they learn, the more confused they get. Index funds, mutual funds, ETFs, hedge funds, 4 options, 0 clarity. So they do what most people do when they're overwhelmed. They do nothing. And that decision, that one moment of inaction, quietly costs them more than any bad investment ever could. Today, we're going to fix that. Because the truth is, once you understand what each of these actually is, the choice becomes obvious. Not complicated, not overwhelming, obvious. And by the end of this, you'll know exactly which one is built for you, and which ones you can ignore forever. Let me show you what this actually looks like. Victor has been investing for 2 years now. His portfolio is growing. His strategy is clear. And for the first time in his adult life, he feels like he actually understands what his money is doing. Then Chris calls. Chris is 36, same income bracket as Victor. Smart, motivated, ready to start investing. But he's been doing research for 3 months. YouTube videos, Reddit threads, finance blogs, and somehow he feels more confused than when he started. Victor, I keep seeing all these options. Index funds, ETFs, mutual funds, hedge funds. What's the difference? Which one do I actually use? Victor pauses. Okay, let me explain each one. And by the end of this conversation, you won't need to ask anyone else. Before Victor explains anything, he starts with the foundation. Chris, imagine 10 people each have $1,000. Individually, $1,000 doesn't buy you much in the market. But if all 10 people pool their money together, now you have $10,000. That pool can buy into dozens of different companies, spreading the risk across all of them. No single person has to manage it. Everyone shares in the results. That's a fund. A pool of money from many investors, spread across multiple assets, managed as one. The 4 types you mentioned, they're all funds. Same basic structure, completely different in how they're managed, who they're for, and what they actually cost you. Start with index funds, Chris says. Everyone on the internet talks about these. Because they work, Victor says simply. An index fund does one thing. It copies an index. Nothing more, nothing less. An index is simply a list of companies grouped together to represent a section of the market. The S&P 500, for example, tracks the 500 largest companies in the United States. Apple, Microsoft, Amazon, Johnson & Johnson, and hundreds of others behind them. When you buy an index fund that tracks the S&P 500, you are buying a tiny slice of all 500 of those companies simultaneously. Some indexes track specific sectors. The NASDAQ follows technology giants like Apple, Microsoft, and Amazon. The Dow Jones Industrial Average tracks 30 large established companies across different industries. Coca-Cola, Boeing, Johnson & Johnson. There are indexes for small companies, international markets, emerging economies, even specific sectors like healthcare or energy. But the principle is always the same. No one is deciding which companies to pick. No one is trying to outsmart the market. The fund simply mirrors whatever is in the index, automatically, mechanically, without opinion. This is called passive management. And passive management has one enormous advantage. It's cheap. Because there's no team of analysts researching stocks, no fund manager making calls, no strategy being executed, the fees are almost nothing. Most index funds charge between 0.02% and 0.20% annually. On a $10,000 investment, that's $2 to $20 per year. So I'm paying almost nothing, Chris says. Almost nothing. And here's what's interesting. Because the fees are so low, and because the fund captures the entire market's growth, index funds have historically outperformed the majority of actively managed funds over long periods. Not sometimes, consistently, over any 20-year period on record. One important thing to understand. Index funds are priced once per day after the market closes. That price is called the net asset value, or NAV. If you place an order at 11 a.m., your trade executes at the closing price, not the real-time price. For a long-term investor, this doesn't matter, but it's worth knowing so you're not surprised when your order doesn't execute immediately. So index funds are basically buy the whole market, pay almost nothing, and wait? Exactly, Victor says. Simple, boring, effective. What about ETFs? I keep seeing those everywhere too. ETFs, exchange-traded funds, are almost identical to index funds in terms of what they hold. Most ETFs also track an index. Same diversification, same low fees, same passive management. So what's the difference? How you buy and sell them. An ETF trades on the stock exchange exactly like a stock, in real time, throughout the day. If the market opens at 9:30 a.m. and you want to buy an ETF at 10:15 a.m., you buy it at exactly the price it's trading at that moment. Index funds, end-of-day price. ETFs, real-time price. For most long-term investors, this distinction rarely matters in practice. You're holding for years. Whether you bought at 10:15 a.m. or at market close makes no material difference to your outcome. But ETFs have one practical advantage most people overlook. ETFs can be bought for the price of a single share. Some trade for under $50. That makes them one of the most accessible entry points for someone just starting out. No minimum investment required. No waiting period. Just open a brokerage account and buy. Many brokerages allow you to purchase ETFs with zero commission fees. And the expense ratios themselves, typically between 0.03% and 0.75%, depending on the type, are still significantly cheaper than any actively managed mutual fund. The only cost you pay is that expense ratio. So ETFs and index funds are basically the same thing, just with different buying mechanics? For most people, yes. Pick whichever your brokerage makes easier to buy. Okay, what about mutual funds? My colleague keeps talking about his mutual fund. Victor takes a breath. Mutual funds are more complicated and more expensive. Mutual funds also pool money from many investors. But unlike index funds and most ETFs, mutual funds are actively managed. There is a professional fund manager, sometimes an entire team, making decisions every single day. Which stocks to buy, which to sell, when to move in, when to get out. Their goal is to beat the market, to outperform the S&P 500 or whatever benchmark they're measured against. That sounds appealing. A professional with resources and research working to grow your money? Here's the reality. Active management costs money. Mutual fund expense ratios typically range from 0.5% to 1.5% annually, sometimes higher. On a $10,000 investment, that's $50 to $150 per year, compared to $2 to $20 for an index fund. That gap compounds over decades into a significant difference in your final balance. And here's the part that makes it harder to justify. The data is unambiguous. SPIVA research consistently shows that over any 15-year period, more than 80% of actively managed funds underperform their benchmark index. Not a few funds, more than 80%. So I'm paying more for someone who probably won't do better than the index? That's the data, Victor says. There are exceptions. Some fund managers have genuine, documented track records spanning multiple market cycles. Not just one good year. But identifying them in advance, before they generate those returns, is extremely difficult. And here's what makes it clear. The fee is guaranteed. The outperformance is not. Some people use mutual funds for exposure to specific sectors or international markets, emerging economies, for example, where a specialized fund may offer access that a standard index fund doesn't. That's a legitimate reason. But know exactly what you're paying and demand proof it's worth it. And hedge funds? Those sound intense. They are. And they're not for us. Hedge funds are private investment vehicles not available to the general public. To invest in a hedge fund, you typically need to be an accredited investor, a net worth of at least $1 million excluding your primary residence, or an annual income exceeding $200,000. These thresholds exist because hedge funds carry risks that regulators consider inappropriate for everyday investors. Hedge funds use strategies that index funds and mutual funds don't. Short selling, leverage, which means borrowing money to invest more and amplifying both gains and losses. Derivatives, complex arbitrage. The goal is not simply to match the market or beat it by a few percentage points. The goal is absolute returns, making money regardless of whether the broader market goes up or down. The fees reflect that ambition. The standard hedge fund structure is called 2 and 20. A 2% annual management fee plus 20% of all profits generated. If the fund makes $100,000 on your investment, $20,000 goes straight back to the manager. That's enormous, Chris says. It is. And to justify it, a hedge fund needs to generate returns significantly higher than what you'd get from a simple index fund, after fees. Some do, many don't. And when they don't, you've paid 2% annually for results you could have exceeded by doing nothing more than buying an index fund. Think of it this way. When a university endowment needs to protect billions of dollars while still generating returns regardless of market conditions, that's where hedge funds operate. That's a completely different league. For someone starting out, irrelevant. Victor sits back. Here's the honest answer. For someone in your position, employed, building wealth, thinking long-term, the decision is not between 4 options. It's really between 2. Index funds and ETFs. Both are cheap, diversified, and built for long-term growth. The only real question is which brokerage you use and whether you prefer end-of-day pricing or real-time trading. For most people, it genuinely doesn't matter. Pick one and start. Mutual funds. Consider them only if you have a specific reason. A sector or market you want exposure to that isn't available through a standard index fund. A manager with a documented, verifiable track record across multiple market cycles, not just one good year. Otherwise, the fees quietly erode returns that a simple index fund would have delivered for almost nothing. Hedge funds. Not your concern right now. Build the foundation first. Everything else, once you've built something worth protecting. Chris is quiet for a moment. So, all that research I did for 3 months, and the answer was index funds or ETFs the whole time? Victor smiles. The answer is almost always simpler than the internet makes it look. That's the part most people never figure out. Most people spend years searching for the sophisticated answer, the complex strategy, the insider option, the thing the wealthy supposedly do that nobody talks about. The irony is that the wealthy often end up back at the same place. Broad diversification, low fees, long time horizons. The tools were never the problem. The understanding was. Now you know exactly what they are. And the choice, the one that seemed overwhelming 3 months ago, is obvious. It always was. The noise was always the problem, never the complexity. This is what finance content should look like. If it landed that way for you, like the video. It tells us we're doing something right. And subscribe, because every video on this channel is built the same way. No jargon, no noise. Just the thing you actually needed to know.